Good afternoon and welcome. Welcome to another of our Webinar Wednesdays, Managing Your Small Business Beyond the Pandemic, number 85. Good afternoon, I'm Kelly Bearden. I am the director of the CSU Bakersfield Small Business Development Center, and we're back for another of these wonderful webinars. Great topic today, great, interesting, current topic that, if you've been around to these webinars, I don't want to talk about the employee retention tax credit. So we're going to spend a lot of time on that today, go over a few other things, see what else you need, and let's get rolling. So we're up to October 27th. I'm not going to be able to wish you happy Halloween, so I guess I just did that. But EIDL is starting to get a lot of attention now that it has moved from a recovery program from being an emergency program, and we'll get into some of the numbers there. Probably quietly, California has passed and signed a new crowdfunding bill for investment or equity crowdfunding, as we call it. It's been a program that's been around for a number of years, signed into law in 2012. Really was something that I thought was going to get a lot more traction than it has now. You might recall, if you were on an earlier webinar, we had the queen of crowdfunding, Ruth Hedges, on and talked a little bit about equity crowdfunding back then. But we'll get into a little bit of the changes in California and see if this is an access to capital tool for some of our small growing businesses that need more equity rather than debt as we go. So today you're going to get a heavy dose of the ERC, the Employee Retention Tax Credits, or Employee Retention Credits, however you want to refer to them as. We're going to get your questions answered on this particular subject today. Last week we introduced a little bit on the California Venues program, and we will give you a quick update in advance of its opening this Friday. We still do not know if it is a first come, first served program, or if it is one that is going to be somehow judged on the merit of the application, the need of the potential grantee, or whatever. So our advice is going to be to, if you want to apply for this program, look today at the requirements and then jump in and actually get that done on Friday. The California Relief Grant Program, which has been around with us for about 10 months now, going back to late December of last year. I'm still finding people that are looking in their emails and finding that they were accepted, that they have a funding proposal in either the $5,000, $15,000, or $25,000. We're also talking to people that received a smaller grant. I believe it was when they were afraid they were going to run out of money. And even though by their standards you were entitled to $15,000, they might have come to you and said, will you accept 15? Well, if that's a scenario that happened in your instance, I think now is an excellent time to call the Lindustry Center, the 800 number, the customer care center for Lindustry.com, who administered and used their platform for the California Relief Grant, and to see if there's a possibility that you could receive your full authorized allotted share. So we've ran into both situations. People that, for whatever reason, they didn't see their email, and also those that were receiving a smaller amount. So that program is still going and is winding down, trying to spend the last of its resources. So maybe an opportunity in either of those two scenarios. We're going to take your questions today. So we're going to have a lot of questions, I'm sure. So go to the Q&A box. We will also be using the chat box for a lot of the resources that we talk about today, a lot of the phone numbers, a lot of the people that we think can assist you on any problems that you're having on any of the pandemic relief programs and getting that money into your business. So with that, let's do what I've been doing lately, and then let me stop my share and let's bring in a poll question for you. So we have a couple of questions today, and the first one's a very, very simple question based on our topic today. And it is going to be, as I launch the poll, you get a single yes or no answer to, I have applied, or intend to apply for the employee retention credit. So single choice, jump in, go away. We have yes, no, or not applicable. Not applicable would be if you don't have any employees. It really wouldn't be kind of a different exercise for you to try to go through that route. So let's see, we've got about 64% of you that are already in. Kind of getting, let's go a little higher, get it up to maybe 70%, and we'll stop the poll and the answer and share the results with you. So last chance, here we go. The poll is ending with 72% of you participating. And yes, 51% of you have either applied or intend to apply for the ERC. 37% of you are no, and maybe that's why you're here today, to get more information, and it doesn't apply to 11% of you. So thank you on that particular poll question. Our second poll question today is going to be something that we do from time to time. Sometimes we come in with a whimsical type question. Sometimes we just want to know what you, our customers, are looking for. So this is our shameless marketing research poll question on the direction where you would like to see and the individual topics and guest speakers you would like to see on Webinar Wednesday. Haven't done this for a while, and as we kind of move through the pandemic, I think it's a great opportunity. So I'm going to launch a two-part poll here. Our marketing research, and again it is, I would like to see the following topics on Webinar Wednesday. Accessing capital, tools for effectively managing your business, marketing, social media, public relations. Maybe you're interested in specific industry discussions, and you can vote for more than one on these. And also current topics, trends, and kind of for a changing recovery environment as we move on to, and then also economic forecasting, and that is our first part of the question. As you go below, you see the second part, and it's your favorite guest on Webinar Wednesdays, and kind of gives you a choice of another 5 or 6 that you can add. If you don't see anything there that you would like, or you'd like to add more, please go to the chat. That is our other box to check for today. So again, 2 very long poll questions on marketing research for the SBDC. We thank you for your participation and really value what you want to see on this webinar. So here's your opportunity to let us know. Is it accessing capital resources, tools for effectively managing your business, the marketing function, specific industry, a lot of the current events that are going on, and economic forecasting on a local, national, and regional basis? And then again, your favorite actual guest. They could be subject matter expert on current topics. I think that fills the bill today. Other business owners that have successes and have maybe issues through the pandemic that you can relate to. Financial experts on related capital programs. Regional and national experts on best practices, and local regional programs that help you grow your business, along with our local academic experts from the business fields, from economics and other trends that we see. Okay, that's a mouthful, and for the benefit of those that are watching a recording of this, you do not get to see the poll show up live, so we have a tendency to talk it up a little bit more. But we have 62% of you in. I'm going to hold out. You know, I know you want to get to Michael Stevenson, and so do I. But I'm holding out for a little bit higher than the 62% response. And I guess I'm not going to get it. So, okay, we're going to end this poll and kind of share the results on the direction that you want to see. And here they are. Tying at 47% are tools for effectively managing your business, and a lot of the current events and topics and trends that are happening in a changing recovery environment. Economic forecasting also very high, pretty high also on accessing capital resources and specific industry discussion. And I know this isn't going to bode well for our producer, Maureen Busher-Dang, our marketing specialist, but marketing is kind of down there. So And lastly, special guests that you would like to see, subject matter specialty experts on current topics was number one at 67%, 47% financial experts on related topics. And there we go as we share the results with you. So there's the first one on the topics. Now we're on the special guest, also with quite a good distribution there on who you'd like to see, but it's subject matter experts and also current events, trends, and topics in a changing environment are today's winners. So thank you. Okay, let's get back to what's going on here. So we talked a little bit about that, and just real quickly jumping into our status reports, we do have these programs that are open. Talked about a lot of them already. Probably the one that I want to give my allocated time, my last 5 minutes today, is going to be not on the crowdfunding bill that we'll talk about later, but it is good to know that that has changed, and hopefully this particular process is something that we will discuss as a viable alternative for many businesses that are looking for capital to grow. So it did change a few of the things, AB 511 through the state of California, that will actually change some things as professional fees and some of the requirements for some of the information that needs to be provided, such as audited financial statements and other things. So let's just quickly jump into the EIDL changes that are going on. There's our one-page fact sheet we like to share with individuals with the changes that happened last month. And again, those major changes are going to be, kind of an increase from a cap of 500,000 to 2 million, and then also jump into the exclusivity window that is closed now. But really, what we really want to let you know is that you can apply for an increase in EIDL. There's a lot of different ways that you can go about that. You can apply for a new disaster loan program. You can use it far different ways than you used to, and a lot of other things that are going on there. So to request additional EIDL funds, you can either do it from your portal or you can go to COVID EIDL increases. Most of the changes that have been going on in the volume and the EIDL funding that has happened has been in increases to existing EIDLs. But more people are using them now that you can use them to pay other debt and other funds. So in addition to that, you can actually now pay commercial debt down, credit cards, and non-federal government-backed debt. You can pay the current portion of federal debt. You can also use it for other uses as well, as for businesses that help you recover, or funds that help you recover. And those business expenses could include machinery, equipment, making your business more efficient, but really being able to pay down existing debt is the big changes that we've seen there. So some of the other issues that you'll want to look at, and you'll want to look at the various degrees of security that the SBA will take on your EIDL loan. So for loans under $25,000, they are unsecured. Once you move up to a higher level, they are going to require increasingly forms of security, including a personal guarantee, and then up to some collateral and some other for the larger ones. So that's a little bit about EIDL. As you know, I still don't know on EIDL is how long the $150 million is going to last when this program opens for the California Venues Grant Program. So we don't know how long the California grant program is going to last with $150 million. The grant requests are up to $250,000, depending on the sales receipts that you had in your business in 2019. What you can do is you can go to the California Venues Grant Program website for additional information and the requirements and items that they're going to request when you file. And again, the program opens Friday, so you have a few days, but I would get in as soon as possible if you are looking at applying for the California Venues Grant Program. You're going to need revenues in the 2019 year and that is earned revenue, not donations if you're a nonprofit, etc., of $1.25 million in order to qualify at the $250,000 level for that grant program. And as you see, the award will scale down based on your earned revenue in California for 2019. Okay, let's get into this. This is a little bit on the employee retention tax credits. We will be taking your questions on EIDL, the California Venues Program, and the employee retention credits. So it's my pleasure to introduce our special guest today, and our special guest was with us about 30 webinars ago, and was really, I can tell you from doing this for 85 weeks, was one of the more popular topics that was discussed. And it is on a confusing topic on, of course, the employee retention credits that are available. So Michael Stevenson is joining us again as a CPA. He's a graduate of Cal Poly SLO, a member of the California Society of CPAs, currently serves as the president of the Cal CPA Bakersfield chapter. He's an alum. He's one of our runners from CSUB. It's always great to have an alum in the house. Enjoys when he's not working, and really probably was happy to see October 15th come along, the last of a series of deadlines that accountants had. As I get a laugh from Michael, because now he's able to enjoy power sports, camping, and spending time with his wife and children. Michael, great to have you here again. Come on over here. I'm going to share this thing. We're trying to keep our distance and take it away. And there's your key right there.
Perfect. I appreciate it. You mentioned this is a confusing topic. Well, the IRS has done their best to make it a little more confusing. So we're going to approach this today as kind of an update from the presentation I did. I guess it's been 6 months ago now.
29 weeks.
So we're going to approach it as an update. We're not going to go through everything. We're just going to kind of go through what's changed and what the significant implications are. Hopefully it won't take more than about half an hour, and then look forward to answering any questions that anybody has. As you get into this, you're going to have more and more questions, so we'll see what we can do to answer those. Before we get into it, little legal disclaimer here. IRS Circular 230 requires me to inform you that any tax advice contained in this presentation is not intended to be written or used and cannot be used by a taxpayer for purposes of avoiding penalties that may be imposed by the IRS. Having said that, happy to answer any questions, but not binding advice on your circumstances based on this presentation. Okay, so we're going to talk about real quick what the original ERC was, because that's still active. You can still go back and claim it. We're going to talk about ERC Part 2, which we briefly talked about 6 months ago. That would be for the period of January 1st through 6/30 of 21. And then they have another part to the credit, which is 7/1 through 12/31. It's technically all the same credit, but the rules change between each of these periods, so we're going to approach them separately. Okay, so just as a reminder, the original employee retention credit was done in 2020. This was the one that you originally couldn't take if you got a PPP loan. That was changed at the end of 2020. But it's a quarterly credit with an annual limitation. So it is limited to 50% of employee wages up to $10,000. So $5,000 per qualifying employee. Qualify for this credit, you either had to have a 50% reduction in gross receipts, in which case you would still get the credit until your gross receipts reached 80% of the original levels they were in 2019. And that's on a quarter by quarter comparison from 2020 back to 2019. You could also qualify for this credit if you had a full or partial government shutdown order. So those are going to be facts and circumstances based. Were you shut down due to a governmental order related to COVID? If you had a supplier that was shut down due to a governmental order related to COVID, you can claim these credits. You can't claim them if your customer just didn't patronize your business because of COVID, or if you were shut down for any reason other than a government order, or if your supplier had labor issues and couldn't get you anything. That doesn't qualify as a shutdown due to a governmental order. Are we okay there? Okay. Have my tech help over here helping me out. So employee retention credit for the Part 2. This is for January 1st, 21 through 6/30/21. This is a quarterly credit, so you can claim the credit for every quarter, where the original one, you can only claim it for the entire period of 2020, up to $5,000 per employee for 2020. This one we can claim every quarter for the first and second quarter of 21, up to 70% of wages, up to $10,000 per employee per quarter. So theoretically, if you qualified for both quarters, you could have $14,000 in credits per employee between January 1st and 6/30. This credit, once again, got a little easier compared to the original one. We only had to have a 20% drop in gross receipts compared to 2019. So once again, we are referencing back to 2019, not to 2020 for our gross receipts comparison. You can also qualify if you had a 20% reduction in the preceding quarter's gross receipts. So what that means is if you're looking at quarter 2 of 2021, if you had a 20% drop in quarter 2, you qualify for quarter 2. If you had a 20% drop in quarter 1, but not quarter 2, you still qualify for quarter 2 based on the look back rule for that. So you have 2 quarters to see if you're eligible. Once again, you can also qualify for a full or partial government shutdown order. Same rules as the original one. Has to be associated with a government order. Can't be a choice on your part. Customer preferences has to be related to a governmental order. All right, so the employee retention credit after 6/30. So they went through and once again, as they've been doing, is they changed the law. So effective 6/30 of 21, still a quarterly credit, still the 70% limitation, still the 20% drop. We also have a 20% look back rule, so you can look in the previous quarter, full or partial government shutdown, or they added this, you can qualify as a recovery startup business. And they also added a term of severely financially distressed employer, which we'll talk about as well. Not sure how many people are going to qualify for that, but we'll throw it out there just in case somebody does. Okay, so what is a recovery startup business? They added this to the law. What does it mean? So a recovery startup business basically means you began carrying on a trade or business after February 15th, 2020. So IRS never defines what a trade or business is. It's facts and circumstances based. So if the business was created prior to February 15th, but you didn't actually begin business activities until after February 15th, you may qualify here as not carrying on a business until after February 15th, 2020. Your average annual gross receipts after that point have to be less than $1 million, and you have to not meet any other criteria. So you didn't have a gross receipts reduction, you weren't subject to government order, but if you started a business after February 15th, 2020, they're going to deem you to be eligible for this credit. Now the credit is limited to $50,000 per quarter, but $50,000 is still $50,000. So if you started a business and you're thinking, hey, I don't qualify for this because we just opened it up, not the case. You probably do qualify unless you're doing very, very well and your gross receipts are over $1 million. The other term they added was a severely financially distressed employer. This is going to be a large employer, which is over 500 full-time employees. If you were a large employer, you had more than 500 full-time employees, if you had a 90% reduction in gross receipts from 2019, you can actually claim the credit regardless of the activities undertaken by your employees. So if we remember back 6 months ago, which I'm sure everybody does, if you were a large employer, over 100 full-time employees for 2020, over 500 full-time employees for 2021, you can only claim a credit for the portion of time your employees spend doing non-productive activities for the business. So you have to actually document what your employees were doing and that they weren't providing activities that were productive to you and you were just paying them out of your goodness of your heart to keep them on payroll. It's a difficult test to meet, but this comes through and says if you had a 90% reduction in gross receipts, it doesn't matter what you paid your employees to do. You can have 10,000 employees, but if you had a 90% drop in gross receipts, you're eligible for this credit, regardless of what those people that you still employed were doing. So, might not apply to anybody here, but if it does, it can be a fantastic tool to get a lot of money out of the government. And I know everybody likes to get money out of the government. Nobody likes to pay it. So, we talked about what a large employer is and how it's limited to non-productive wages. If you're a large employer for 2020, you're technically a large employer if you have over 100 full-time employees. 2021 credits, they moved the number to 500. And the IRS came out with some guidance that was a little interesting. Most people, when they read this and they read full-time employees, based on the code sections and whatnot the IRS was referencing, people believe that full-time employees also meant full-time equivalents. So if I have 1,000 employees that all work 30 hours, I've got more than 500 full-time employees. Because if I take 1,000 times 30 hours, that averages out to 750 full-time employees. Well, the IRS came in and said, no, we don't. That's not how you do this test. The test is actually based on people that are full-time employees. You don't count part-time employees. So based on this, you could have 1,000 part-time employees and be eligible as a small employer because you don't have more than 500 full-time employees or more than 100 full-time employees. So a little interesting there. If you are a large employer and you thought, hey, I can't get this because my full-time equivalents are more than 500 or more than 100, not necessarily the case anymore. I did see that somebody raised their hand. How do I access that here?
We'll get it at the end.
Okay, we'll do it at the end. Okay, so want to refresh your memory on what wages are for the employee retention credit. For a small employer, it's basically going to be anything you pay to your employees. It's going to include salaries, wages, bonuses, commissions, vacation, sick pay, your portion of the health insurance you pay for the employee, but not the portion of health insurance you pay for the employee's dependents. So you have to actually go through and figure out what health insurance you're paying for the employee specifically. Wages paid to a professional employee organization, you have something like that set up, you can claim the credit on the wages that you pay to that PEO. Wages paid to owners. Originally we talked about how this was a no, but the IRS has guidance that's come out that is contradictory to what the consensus reading of the law is. It's actually a really bizarre publication by the IRS, but we'll get into that in a minute, and it opens us up to a lot more people as well. Wages claimed on the PPP application, we have to look at that. You can't claim wages for the employee retention credit that you've also claimed either PPP, on your PPP application is forgiveness, or any federal credits that you've taken on those wages. State credits and state programs are okay. If you have a state program in which you've used part of your wages to qualify for a state local grant, those wages can still be used for the ERC, even though you're technically double counting those wages because the federal government doesn't look at those state programs, it only looks at the federal programs. If you're a large employer, most of the stuff's going to be very similar. Only difference is you don't get any credit for vacation sick pay for your employees. That was deemed to be a liability of you to begin with and not eligible for this credit. Okay, so we talked a little bit about how the IRS made this really bizarre ruling. So the IRS came out with a position that a majority owner can take an employee retention credit if no other related persons are employed. Okay, so it's a really weird reading of the law, but you know what? We're going to take it. So we have a two-part test is what this does. Is we have to determine who is a majority owner and who is a related person. One thing we're going to find is that a spouse is not a related person. So in the IRS's rules, they're going to include everybody at the kitchen sink, but they're not going to include your spouse. So let's see here. I'm going to go forward just a little bit here. We've got them out of order, but so the wage test part one, who is a majority owner? Majority owner is an individual who owns an entity or any part of an entity plus all ownership from related parties. So you will take everybody's ownership that's related party, you will aggregate it in every single person that's related party will have that ownership. So we're going to aggregate brothers, sisters, a spouse, ancestors, lineal descendants. We're going to basically take your family tree and we're going to say that they're related persons. So to clarify this, if me and my wife own a business, I own 100%, she owns 0%, she's still treated as owning 100% because my 100% aggregates with hers. If I own it with my parents, 50-50, that will be we'll each be treated as owning 100% of it because I take their 50%, add it to mine, they take my 50%, add it to them, and everybody's 100% owner for the purposes of this test, which make everybody majority owners. Okay, so once we figure out who the majority owners are, we have to figure out, did they have any related persons that paid wages to? So basically what happens is that the majority owner's wages are disallowed if any related party receives wages, okay? So if I don't have any related parties, my wages can qualify for the employee retention credit. If I do have related parties on my payroll, my wages don't qualify for the employee retention credit. So they've gone through and identified a related party is a child, descendant of a child, so any lineal descendants, brother, sister, stepbrother, even stepsister, father, mother, ancestor of either. So all of your ancestors, a stepfather, stepmother, son, daughter of a brother or sister. So we're talking about nieces and nephews here, brother, sister of a father, of a mother, a son-in-law, daughter-in-law, father-in-law, mother-in-law, brother-in-law, sister-in-law. So they're aggregating all your in-laws, but what you're going to notice here, a spouse is never listed. So if you have a husband or wife that have an S corporation and they both get wages, they both own 100% from the aggregation test. However, neither one of them has a related party that also receives wages. So in this case, both the husband and wife's wages would qualify for the employee retention credit. Now, if you had a husband and wife who employed a niece or nephew, then they both have a related party that they're paying wages to, and all the wages get thrown out for the employee retention credit. So it gets to be, it's really, really technical, and it's a really bizarre rule that seems to go in the face of what the law read, but that's the position the IRS has taken, and to be honest, it's going to be very beneficial for a lot of people, so we're going to try not to question it too much. Let's see here. There were a couple other clarifications by the IRS that I want to go through in this guidance as well. If you were not in business in 2019, the look-back period of 2019 can be substituted for 2020. Basically what you're going to do is you're going to use the first quarter in business as the base period for the gross receipts calc. So if you weren't in business until third quarter of 2019, when you get to 2020 and you do your look-back compared to 2019 receipts, you'll take that third quarter gross receipts number and you'll move it back and use it for first, second, and third quarter of 2019 for the look-back test. It's kind of an unfortunate ruling, to be honest with you, because unless you started the business January 1st or on one of the calendar quarters, you're probably undercounting your gross receipts by a significant margin. I know we looked at a business that had started up and they had done a soft opening of their restaurant, had 5 days of gross receipts in one of the quarters and were required to use that looking back for those previous quarters. So that one's not a great result in our favor, but you win some, you lose some. IRS has clarified, they clarified this a while ago, but the credits are taxable for federal purposes. They're likely not to be taxable for California. California generally doesn't tax federal credits. So it's unlikely that California will try to tax the employee retention credits. Of course, it's California, so anything could change. If you use the look back method to determine if you qualify in second or third quarter or first quarter of 2021 by looking at the previously or the preceding quarter, we do not need to consistently use that election. So you can do that election on a quarter by quarter basis. That was pretty much what we believed, but the IRS did conform to that and identify that that is their position as well. They also clarified this kind of a weird one. Qualified wages, there was questions about if tips would be included in wages for restaurant businesses. And the IRS position is that cash tips may be included in wages. However, non-cash tips are not wages. So if a server gets tips paid on a credit card that you report on your 941s, those don't qualify, but the portion of tips that were paid in cash that may be reported there are wages. They're under different revenue code sections, and the IRS believed one was includable and one wasn't, but it's just a really weird differentiation there. As we talked about before, the employee retention credits are not reduced by state and local relief programs unless they're authorized as part of federal law. So your California programs, your local grants, those wages that you use for those can be used for purposes of the employee retention credit as well. We do not need to pull them out. As a reminder to everybody, when we get to the calculations of pulling out wages, the wages deemed to be used for PPP programs or any of your other programs that you applied for is they're going to take the total amount forgiven less the non-payroll amount to get to a deemed payroll. So even if you had a $2 million PPP loan, you had $500,000 in non-cash expenses and $2 million you reported as wages on your forgiveness application, the IRS will go and they'll say, hey, we had $2 million in PPP less $500,000 in non-payroll. So our deemed payroll that we use for the PPP was only the $1.5 million. So they've confirmed that position. That was pretty simple, but just a reminder on that. So in extending the ERCs into third and fourth quarter of 21, the IRS has also gone through and extended the statute of limitations. I just want everybody to be aware, if you apply for a credit from July through December of 21, the statute of limitations is actually going to be 5 years from the date the return is filed, or the original date of the return. These are going to be your payroll tax returns. You're probably going to be paying them, doing these on an amended payroll tax return. So it's 5 years from the date you file. And that's a differentiation from what it usually is. Standard statute is 3 years for the IRS. So any ERCs for the periods preceding 7/1/21 are going to be subject to a 3-year statute. But just be aware that when you go through and you do these things, you've got to keep your records for a little bit longer because they've got 5 years to audit you on them now. The reality is they're getting hundreds and thousands and millions of these applications that they can't process and they can't look through. So it's really not a good situation over the IRS associated with these. I'm going to hop back here real quick to the future legislative outlook. A lot of people are asking what's going to happen with these things. Well, first thing is that keep in mind these ERCs are really big dollars. They're a ton of money. Probably $2 to $3.5 trillion in ERCs are going to be out there and going to be filed with the IRS, which would be 2.5 to 3 times the size of the PPP programs. So they are huge money. I don't see a way in which they're going to be extended after 12/31 just due to the financial situation in Congress. And actually the current infrastructure bill would cancel the ERC for the fourth quarter of 2021. Even though it hasn't been passed yet, they can go back and make it retroactive to the date the bill was introduced, and the bill currently calls for the ERCs to be canceled effective 10/1. That means for the period of 10/1 through 12/31, it wouldn't be available. It does not mean that if you haven't applied by that time, you don't get it. It just means that for those periods, you can't claim the credit. At this point, I'd like to open it up to questions. If anybody has any questions or has any thoughts that they'd like to share on this program.
Okay, well let's go up to the question and answer box and see what we have in here. Let's see, a couple idle questions, and go ahead if you have a question, pop it in that Q&A box, and we'll get to it right now. If you put it previously in the chat box, we'll check those before we finish up. But really, the place you want to be is Q&A right now. So let's jump into, are the idle advance and supplemental in California grants taxable?
So the idle advance grant, which is the $1,000 per employee that you originally got, that is actually non-taxable for federal and California. Any grants or money received under the CARES Act is going to be non-taxable for the feds, so that would include PPP as well. California has different rules. They've gone through and said for the PPPs, you have to do a look back, look at gross receipts, and a test there to see if it's taxable for California. But the grants were not included in that part of the legislation, so the grants are going to be non-taxable federal and California. So any non-taxable California grants are going to be taxable income. So those are things that you're going to have to pick up as taxable income. That is going to be taxable.
Okay, great. Next question is, we asked our poll question if you applied or intended to apply for the ERC. Do you have to apply for it somewhere, or can you enter it on the 941? Why don't you go through a little bit of the application process, the different options, because there are different options, and options in taking it either as a future tax credit or as a refundable tax credit now.
When we say apply, it's not really an application process. The IRS can't turn you down for this credit. It is a credit that's written in the law that you just have to do the calculations and submit it on your payroll tax returns. So you can do it on an originally filed return, or you can do it on an amended payroll tax return. What we're seeing is most clients do it on an amended payroll tax return just for the simplicity of it. You can also, if you're a small employer, you can apply for an advanced refund of the credit. It is a refundable credit on the payroll tax returns, so applying for it as an advanced credit really isn't getting it to you any sooner. To be honest with you, I don't know of anybody in the country that's actually received their refund from the ERCs. My understanding is that there's an office of the IRS that has hundreds and hundreds of thousands of these things that have been processed but just not paid. And my belief, honestly, is that they don't have the money in the treasury to pay them. So they can't pay them until they raise the debt limit. But they're sitting there, they're processed, they just haven't been paid yet. IRS is supposed to pay them out within 90 days. Hasn't happened. So you can also apply to carry these things forward. One thing you can do is, if you know you're going to be eligible, you can not make your payroll tax payments. As long as the credit amount covers the payroll tax payments that should have been made, you're okay. So that's an option also if you're looking for cash. In order to conserve cash, is you can figure out what these things are likely to be, adjust your payroll tax payments to match that, and you know, that way you never actually submit the money to the IRS to ask for the refund back. Probably the simplest way to do it if you need the cash now.
And also, just kind of a little question regarding the actual change that's going to happen if you claim the tax credit. Because if you get the tax credit, then I'm under the understanding that you have to reduce your wages by that similar amount.
That is
Which,
correct.
of course, I will take the cash instead of a tax deduction any day of the week, right?
Yes, that's absolutely correct, is you're required to reduce your wages for the period in which you claim the credit. So if you have $2 million in wages, you claim a $500,000 credit, you will actually reduce your wage expense by that $500,000, so you're only gonna get a deduction for $1.5 million instead of the $2 million. For California purposes, you will still get a $2 million deduction, but $1.5 million for feds.
Okay, great. Okay, next question. Are there any agencies assisting with the ERC?
There are a lot of agencies assisting with the ERC. Most of the payroll, paychecks, payroll people, ADP, all of them have programs to do it. I'm not a fan of their programs just because of the cost. These are complicated credits. They're complicated to do. There's a lot of documentation to keep, but some of these payroll organizations are charging 18%, 18, 20, 22% of the credit amount, which is excessive in my opinion. If you've got 1 or 2 employees, maybe that makes sense, but if you've got 50 employees, they're gonna be charging you $40,000 to do these calculations, which is just ridiculous. 50 employees, our cost to do it is probably about $5 grand a quarter. So to me, some of these things are just excessive. Reach out to some of these people and find out what they're charging. See if it's something you're comfortable with. You can always, if you want me to look at it, I'm happy to look at it and go through it with you and see if you do qualify, and if you do qualify, what the rough cost to get it done would be.
Great. And also, as far as other agencies, I know here at the SBDC, it's just a little too convoluted. It's too much of a legal aspect. We try to stay away from the legal consulting side of things, and the very nature of this tax credit has evolved into being that complex and that difficult. There could be one of our other centers throughout the Central California region that is doing them with a expert. I will check on that, but I think you're best sticking with your professional, your payroll processor, checking on the cost, of course, your accountants and others in trying to assist you with this. So what are the forms that are used to complete an ERC? You mentioned the 941 payroll forms, and you mentioned amending those. Are there any others?
No, as far as government forms, all we really have is a 941 or a 940X that you have to submit. There is a worksheet that will go with it, but that's in the 941, 941X instructions. The backup you have to have is you have to have your calculations as far as how did you calculate payroll for everybody? Did you back out the other credits? What were the employee healthcare costs and documentation of all that stuff so that if you're audited, you can support your deduction. You don't want to take a $50,000 credit on these things and have no support. So really the forms aren't the hard part. It's making sure you have the documentation back up so that you are safe going forward.
Yeah, with a 5-year statute of limitations. Wow. Okay, so let's see, next question is, so if a majority owner has a child receiving payroll, you are not eligible for ERC for that purpose?
Unfortunately, that's correct, because the way the rules work is that if you're a majority owner and you have a related person who would be a child, you are not eligible for either your wages or the child's wages. Like I said before, it's a really weird ruling by the IRS and a really weird position for them to take that doesn't make a lot of sense. And a lot of people have put children on payroll in order to get them funded on retirement accounts and things like that, and to reduce their tax liability. It's just, that is the case. There's no way around it, that's the case.
A little harsh editorial comment. Okay, how do you check on your ERC to see if it is being processed?
That's a good question.
That's a great question.
I wish you the best of luck on that one. What you're going to do is, once you submit, you can call the IRS and they'll tell you if they've received it. Basically what they're probably going to tell you is that, hey, we received it, it's in processing, and that's all they're going to tell you. Really, the IRS is kind of a black hole right now. It's really hard to see where anything is there. It's just everything is processing. So you can check to make sure they received it, but you're really not going to know where it stands and when you're going to get approved, or I shouldn't say approved, when it's going to get processed and the refunds are going to be issued. It's just the IRS can't provide that data right now.
Okay, my wife and I are co-owners of our LLC business. We both are W-2 employees for our business as well. Based on your presentation, I believe we are eligible for the ERC, correct?
Yes, that would be correct. So if you, and I'm going to clarify this, based on the information here, that's correct. If your wife, you and your wife are both owners of the LLC, you are both majority owners, but neither one of you, as long as you don't have another related party that you employ, have any related individuals that are employed by you. As such, your wages qualify for the ERC because they are not disallowed due to the payment of a related person.
Well, that's good news. Okay. Here's one. My accountant is questioning whether the business had to be closed in order to claim the credit. Our receipts are down 20%, but we never closed. Do we qualify?
Yes, you would qualify as long as and the 20% needs to be compared to the 2019 year, not 2020. But if you had a 20% drop in either basically from fourth quarter of 2019 through third quarter of 21, compared to those respective quarters in 2019, you do qualify. You do not have to meet all the criteria listed here. You only have to meet one of them. So the criteria are 20% reduction, or 20% reduction in prior period, or subject to a full government shutdown order. So if you qualify for any of those, you qualify for the ERC.
Okay, if you qualify for ERC to being shut down by government order, do you qualify for all quarters from the shutdown until now, or all quarters in which they were forced to close?
So the ERC for a government shutdown order is going to be based on the period in which you were affected by the government shutdown in a more than nominal manner. So if you were shut down on April 5th and you were allowed to reopen on June 6th, you would only get the credit from April 5th through June 5th. Now, what's happened with a lot of restaurants is you were subject to a full shutdown order where you could only do takeout, and then you were allowed to have 50% in-person dining and then 25% in-person dining. When you do if you're still subject to the partial order, as long as you can show that it had a more than nominal effect on your business, we weren't able to bring as many people into the dining room, so we couldn't serve as many people. Then you qualify for those periods, but it is only for the period in which you were subjected to the government order and were shut down or partially shut down.
Okay. Did you say that wages had to be reduced in order to claim the credit?
No, I think if you claim the credit when you do your tax return, you will report the wages less the credit you received as a deduction on your federal return. So you don't reduce the wages to claim the credit, but if you claim the credit when you do your tax returns, your deduction associated with the wages will be reduced by the amount of the credit you received.
So let me walk through this from an accounting perspective. On an accounting perspective, on keeping your books, you would still actually use the full amount. And what transaction would you come in with later for as far as wages? Because you want to keep your books consistent with accounting principles, and tax is going to be different. So
correct. So what you would do is when you forward your books, what you're going to do is you're going to report your wage expense that you normally would, reduce cash, pay your wage expense. When you get these credits, you would actually set up a receivable for the ERC. So a receivable from the IRS for whatever the amount of the refund is going to be. The offset to that would be wages if you're tax basis on your books. If you're a GAAP basis taxpayer, you actually give financials to the bank. You would want to report that as other income. When you receive the credit in the mail, you would increase cash and remove the receivable from your books. The key here is that you need to let your accountant or your tax professional know what happened and how you've recorded it so they can make the appropriate adjustments for your tax returns, because we don't want to be taxed on these wages or this credit for California if we can avoid it. There's no reason to give the state of California more money than you guys already are.
Boy, I can open up a can of worms, can I? Okay, so next question, and I'm going to try this one, Michael, and you could correct me if I'm wrong. I use a DE7 quarterly, not the 941. Okay, so on that, the DE7, I believe, is the state of California reporting form for payroll taxes, while the 941 is a federal reporting of your payroll taxes, so you should be doing both.
Correct.
Okay, we have a majority owner on payroll and a child of his on payroll. Am I understanding correctly that neither of their wages can qualify for ERC?
In short, yes. Because he has a related party that works for him, his wages and the related party's wages are no longer eligible.
Okay, so that's questions. I'm going to go into chat and just go through and make sure we didn't miss anything here. Okay, first question. I just want to read through it briefly to see if we already answered this in the Q&A box. But my wife and I are co-owners of a business. We are also the only W-2 employees. I think we did answer this. Are we eligible for ERC? And you said?
Yes, we are.
Yes. So then also in the chat, you'll see some resources. There's the EIDL Changes. So for increasing or actually getting a reconsideration, if you were turned down initially, you can go back. You can still apply for the EIDL loan. And you know, in this building where I'm located, we're EIDL fans. So if it's something that can help your business, you have until the end of the year on EIDL. You will be paying back 3.75% interest over a 30-year term, which I think is going to be incredibly cheap money before we realize it, if it isn't already. There are some more links in here as far as the toll-free numbers. We also have EIDL intake, EIDL FAQs, so we have plenty of EIDL things in here. The California Venue Grant Program that is going to be opening on Friday is there. And then also in your chat box is Michael Stevenson's contact information if you would like to contact him. So for those of you that are going to ask if his presentation is available, what we will do is what we do regularly on Webinar Wednesday is probably by the weekend or the weekend send out all of these FAQs and all these resources that are mentioned, a recording of today's webinar so that you can actually go back through that if you so desire. So keep those resources coming and let you see and kind of a lot of information to digest today. Incredibly, it even gets more complex as we go. It even gets more complex. It's hard to believe they could do that to us, but they do. So hitting the Q&A box one last time. We're good there. So Michael, thank you so much for coming in.
My pleasure.
Really appreciate the opportunity to sit here with you and go through this information and making yourself available for people to assist them with this particular issue.
Absolutely, it's a complicated issue, and hopefully we've shed some light on it. I don't think we've answered everybody's questions, but at least give you guys a little bit to go on.
Yeah, so this will be also on our YouTube channel, where all 85 previous webinars and some of the ones we did earlier, and that's the CSUB SBDC YouTube channel. Okay, we're wrapping it up. For Michael Stevenson, I'm Kelly Bearden. Thanks so much for joining us. We'll be back with number 86 next week. Take care, everybody. Bye-bye now.